Hey everyone, welcome back to Corporate Decoder, the place where we uncover the secrets hidden in plain sight. And today we are diving deep into Kyndryl Holdings Incorporated latest financial report, a document that promises more twists and turns than a corporate legal drama. Think of this as your financial decoder ring for the tech world. You know the drill. If you love getting these kinds of breakdowns without the corporate jargon, smash that subscribe button and join our Discord community linked in the description. It is where the real financial fun happens. Alright, so Kyndryl, a company that manages the gnarly IT infrastructure for thousands of clients across the globe, has just dropped its quarterly report for the period ending the 31st of December 2025. This isn't just numbers on a page, it is a story of where the company stands, how it made its money, and what challenges lie ahead. Let us unwrap this financial present. First up, the income statement. For the last 3 months of 2025, Kyndryl brought in $3.9 billion in revenue. That is a small step up from $3.7 billion in the same period last year. But here is the kicker: their constant currency revenue, the revenue adjusted to remove the effect of currency shifts, actually showed no growth at all. This means the slight reported increase was purely from favorable currency exchange rates, not from selling more services. For the 9 months of the year, total revenue hit $11.3 billion, a tiny increase from $11.2 billion a year ago. Again, constant currency revenue tells a slightly different story, a drop of 2% showing that without currency fluctuations, things were a bit tighter. Now let us talk about profit, or rather in this case a bit of a dip. Net income for those 3 months came in at $57 million. That is a significant drop from $215 million in the same period of the previous year. The company blames a one-time gain from selling their securities industry services platform last year and a new cost this year related to an old dispute. For the 9 months, net income was $181 million, down from $183 million a year ago. So while revenue is chugging along, profits are facing some serious headwinds. Moving over to the balance sheet, this gives us a snapshot of the company's assets, liabilities, and equity at a specific point in time. Total assets are sitting at a hefty $11.3 billion, a rise from $10.5 billion at the beginning of their fiscal year. A big chunk of that increase comes from deferred costs. Think of this as money spent on services that will be delivered or recognized in the future. They also have almost $1.4 billion in cash and cash equivalents, which is a decent cushion, but notably lower than it was at the start of the year. Liabilities, the money Kyndryl owes to others, are also up, sitting at $10 billion. This rise is largely due to an increase in other non-current liabilities, meaning long-term debts or obligations. They have long-term debt totaling over $2.2 billion, which is a substantial amount. Equity representing the owner's stake in the company is around $1.3 billion, seeing a slight dip from the previous period. This reduction is largely due to the company buying back its own stock, a move that can sometimes signal management confidence or a desire to boost earnings per share. Let us look at how Kyndryl is managing its money through operations, investing, and financing. For the 9 months of 2025, operating activities brought in $450 million. That is positive cash flow from the core business. However, investing activities used up a significant $436 million. This usually means they are investing in long-term assets like property or making acquisitions, which explains some of their asset growth. Financing activities, on the other hand, show a much larger outflow of $448 million. This is primarily driven by those share repurchases previously mentioned. It is a clear sign that the company is actively returning capital to shareholders by buying back its stock. Now, let us zoom in on the segments. Kyndryl breaks down its business into 4 main areas: United States, Japan, principal markets, and strategic markets. Revenue growth in constant currency, which is a key metric to understand the true performance without currency swings, shows a mixed picture. While some segments saw reported growth, the constant currency numbers are a better indicator of underlying demand. Adjusted EBITDA, a measure of profitability before certain expenses like interest, taxes, and depreciation, paints a clearer picture of operational performance. Total adjusted EBITDA is around $2 billion for the 9-month period this year, up from $1.8 billion last year. This indicates that despite some revenue pressures, the company is managing its core operational costs effectively and becoming more efficient. In the United States, revenue was down 5% over 9 months, but adjusted EBITDA jumped a strong 20%. This is a good sign, showing improved efficiency and cost management in their biggest market. Japan is showing a similar trend. Revenue is slightly down year over year, but adjusted EBITDA is up significantly. This points to operational improvements despite a challenging market. The principal market segment, which lumps together countries like Canada, France, Germany, and India, saw a 5% revenue increase over 9 months, but a drop in adjusted EBITDA. This suggests that while they are winning business in these regions, the cost to deliver those services has increased, impacting profitability. Strategic markets revenue saw a smaller increase of 2% over 9 months, with adjusted EBITDA also rising. This segment seems to be on a more stable and positive trajectory. Looking beyond the segments, it is crucial to understand the broader financial health. Kyndryl's total assets are growing, but so are its liabilities. Their debt continues to be a significant factor representing a long-term commitment. The company has been actively managing its debt profile, refinancing and issuing new notes. While this shows proactive financial management, it also means interest expenses remain a notable cost. Now, for a point that really grabs your attention, the report highlights material weaknesses in internal controls over financial reporting. This is a serious issue for any company, and it essentially means there are significant flaws in their systems that could lead to errors not being caught in time. They mention a lack of transparency, particularly with executive leadership, and issues with internal investigations and communication. This is a red flag that investors will be watching closely. The good news is Kyndryl is not just acknowledging these weaknesses, they have laid out a plan to fix them, which includes enhanced training, better communication protocols, and improved investigation procedures. However, it will take time to see if these measures are truly effective, and these internal control issues can present significant risks if not addressed properly. Kyndryl has a share repurchase program in place, and they have been actively buying back their own stock. For the 9 months ending the 31st of December 2025, they spent over $250 million on these repurchases. This can boost earnings per share, but it also reduces the cash available for other investments or debt reduction. The company also includes a section on forward-looking statements. This is standard, but it is Kyndryl's list of risks that is particularly telling: competition, technological shifts, challenges in attracting talent, economic uncertainties, and the potential impact of legal and regulatory issues are all among their stated concerns. The internal control issues also fall under these broad risks. So what is the story here? Kyndryl is a massive company navigating a complex global market. They are showing signs of operational improvement in some areas, particularly with cost management and efficiency gains offsetting revenue pressures. Their financial position is solid with substantial assets and access to credit, but the level of debt and increasing liabilities are worth monitoring. The most critical takeaway, however, is those material weaknesses in internal controls. While they have a plan in place, this will require diligent execution and careful oversight. It is a reminder that even the biggest players can have underlying structural issues. The company's direction seems to be focused on efficiency and profitability improvements, which is a smart move in this market environment. The key will be their ability to execute on their remediation plan and rebuild investor confidence in their financial reporting. Alright, that is our deep dive into Kyndryl Holdings Incorporated quarterly report. What are your thoughts on their financial performance and those internal control issues? Let us know in the comments below. If you found this breakdown helpful, give this video a thumbs up. It really helps us out, and subscribe for more corporate decoding. And hey, do not forget to join our Discord community linked in the description, where we dissect these financial documents further. Thanks for watching, and we will see you in the next video.